Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is host Richard Bernoulli. Today is August 12th. We have Bill Fleckenstein and Ira Harris today. Bill is a professional money manager with over 30 years of experience. He's written daily commentary on market action since 1996, and FleckensteinCapital.com launched in 2003. The Daily Wrap is an analysis of market action from Bill's legendary contrarian viewpoint. The purpose is to educate even a novice investor of a critical perspective that's misrepresented and underreported. And Ira is independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003, and recently also a stint there as well. Welcome, gentlemen.
Thanks.
Thanks for having us.
Yep, this is great. Appreciate it.
Great. I thought we'd begin, Bill, with your global macro view on the economy and the financial markets.
Okay, kind of a broad topic, but I think if you look at from the 30,000 foot level or so, the macro environment isn't particularly conducive to financial assets doing well as a group. The economy in America is still growing nominally, but obviously there's a reasonably high inflation component to that growth. Therefore, real growth is, very, very small, percent, maybe a little more than that. But as a friend of mine points out, the economy feels different if you have nominal GDP growth at 5 and inflation at 4. That's 1% real. That feels different than 0% inflation and 1% GDP growth. So this particular business cycle is quite a bit different from in the last 25, 30 years. Of course, in the last 25, 30 years, we've had two bubbles, and we've had the Fed print money in the wake of those bubbles, and that's what's created the next bubble. And so from an economic standpoint, inflation is still too high. GDP growth has slowed down. We have an out of control budget deficit. We have poor political leadership in America, across the globe. There's all kinds of trends that are not particularly capitalism friendly. I mean, if you're gonna get after free speech, what's next, right? So those things are all a little disconcerting. Valuations in America are ridiculous in the aggregate, but that is relative to history and GDP. But that is also skewed by the fact that we have this so-called Mag 7, which have truly obscene valuations in terms of, you have Apple, which is a $3 trillion company that hasn't had no real growth for 18 months. Warren Buffett selling it, and still it goes up. And those things occur largely due to the incredibly warped outcome that has been driven by the fact that passive investing on the part of Vanguard and BlackRock on behalf of corporate America's defined contribution plans, because of how they skew it to market cap weighted, we've created this weird situation where the biggest companies, which by definition can generally grow slower, have the high valuations, and then that's caused people to reverse engineer momentum strategies and things like that. So you've got an unhealthy mix of speculative forces at work that have largely conspired to push stocks higher up until recently. And now that may be stalling. At some point, the passive bid won't be big enough, and we'll have our own version of what happened to Japan as the yen carry trade blew up last week. That's my concern. I don't see any reason to think it's tomorrow. And usually when problems are big, but they're further down the road, people don't worry about them. I think you have to be aware of the dangers, but that doesn't mean you have to act like the dangers tomorrow. You have to be alert to the fact that we could wake up next Tuesday and say, oh my God, this and such has happened. I need to become much more defensive. And you have to know how you're going to get there and what you're going to do. But you can't make the mistake of as a friend of mine like to say, just because you don't want to think about pulling out the putter when you're in the tee box. If you know what I mean, there's an order to how these things have to go. So I think the economic environment is poor. Valuations are poor. I think the risks are quite high. And so that's how I view the equity market and the economy in the aggregate. So.
Well, that's a lot of different touch points. Yeah. Great insight. Your thoughts, Ira?
Well, first and foremost, Bill, I don't even want to take out the putter on the green. I'm probably better off on the tee box. Anybody who knows my golf game. But I mean, everything that Bill just went through, I can't agree more, because really what we're talking about, and we saw it, you know, and a couple of weeks ago, I did a podcast with Daniel Lecaille before all this, because then I went on a trip and we were talking about this very thing with, you don't know, as you don't know when this is going to give way. You don't know when the system gets over leveraged, what will be the catalyst that'll make this happen. We don't know. And you beautifully said it, but you said it for years. And I, as I talked about, having read you and interviews with you in Barron's for so many years, but we don't know. And the system is so over leveraged because, again, it's only 2 years ago, we had 18 trillion of nominal negative sovereign debt in the world.
Yeah.
I mean, people forget that.
Right.
That leads to quote unquote malinvestment. And it leads to things that exist out there that we don't even know. Now, I would argue, and I did argue 3 weeks, you could see that something was coming with the yen, because the yen went up to me, a preposterous level, because it's too, the underlying economics is built to really didn't match what the financial world was doing. And that's where, to me, the Fed and other central banks lose it, because their models are not built on that. They can't possibly say, well, this is, financial, because the financial comes back to their responsibility. I mean, let's think about it. The Fed was raising rates while they were also continuing with QE, right? I mean, and then the ECB, who had to outperform the Fed because they have a different situation. And of course, Christine Lagarde, she's got to balance something that can never be balanced until they get fiscal harmonization or a capital markets union. But so she's trying to balance that. So of course she stayed easier, and the Japanese, okay, we're not really suffering inflation. They had less inflation than everybody else, and yet the currency over those 4 years, from the low of 2020, March of 2020, when the financial COVID put in its low, the yen depreciated 55, 56, 57% with less inflation. And as a developed world currency, that is highly unusual, just so highly unusual, because usually a developed market currency suffers, it'll suffer from low interest rates, but the causation is then becomes higher inflation than everybody else. But this was totally a financial situation. So Bill takes us off there, and that's where we're going to go from. Where will the next leg of this? I have no idea. I know JP Morgan comes out and says, well, it's over. How do you know it's over? We don't even know where the real leverage risks are in the system. You don't know that it's over. We just don't know. It's not that it's over. We don't know what the catalyst is going to be for the next leg of it.
To pick up where you left off there, I too have been had my eye on the yen, and I dabbled in it. Actually, I was long. I'm flat now, but I caught a big piece of this move. And part of the reason is I have a friend named James Aiken, who is very well plugged in. And we just did on our Endgame podcast, we interviewed him a couple of days ago. Yeah. And his credentials are far better than mine. And I'll just share the takeaway from that is that we probably got whoever were the most leveraged players, either with their yen borrowing or what they were doing with their yen borrowing, whether they were long Mag 7 or Mexican debt or whatever they were doing, we probably got most of them body bagged and out of the way. But the structural deficit of Mrs. Watanabe, you know, being basically short yen and long, you know, T-bondos. That is, and the other institutions, that will take a while. But James feels that the panic version of it is over for now, and that we're going to have the steady undertow of capital being repatriated back to Japan. Now, that doesn't mean there aren't other pockets, as Ira suggested, of weakness that might ultimately be triggered by the start of this change. But there are a lot of people, I think, that have their hair on fire that are waiting for the next leg of the yen carry trade to blow up imminently. And I think it's probably not likely to blow up imminently. The next leg may take longer and go in a different path. But I suspect that the path of the yen is north, i.e., you know, we're at 140, whatever we are now, 147, 148. I don't know where it goes to in the short run, but I think, you know, ultimately it'll be, you know, 130, 120 again down the road.
Let me just add one. It doesn't surprise. Okay, so you go to Aiken. Now, James and I know each other very well. In fact, in 2007, when we were having coffee, I gave James a whip inflation now button.
Oh, good. Oh, okay. God, now there's a classic. That was from Ford, right?
Right. But so James and I, and he is truly one of the best plumbers in the world. But I know James via Bernard Connolly. This is a very powerful. And then, of course, Connolly gets you Aiken, and I have great respect. I know Bernard very well. But then gets you to Zoltan Pozar, because Zoltan worked with Aiken. So, I mean, I just have to put that. That's such a great, and I'm glad, because I have nothing but great respect for James Aiken. It really is. So you mentioned him. Doesn't surprise me that you were long yen. I went on a cruise. I was the same position, but I was looking for it. But I lost more than a little money, you know, pursuing this look, thinking it was going to happen sooner. But again, as we learn in this business, if you're right at the wrong time, you're wrong.
I was lucky enough to time this one perfectly. I'm not perfectly, well enough that I didn't suffer a great deal. Because normally that's my MO too. I get there too soon and have to get tortured waiting for the events to change. So believe me, I've been there and done that more than I'd like to remember.
Yes. Sorry, Richard. So I just wanted to.
No, these are, and also just to note, these charts are from Judd Hirschberg on White Wave Trading, graciously provided to us for being able to help on the discussion.
Thank you, Judd.
Yeah, just wondering also further to that, Bill, your thoughts on what you've been big on as what you see as a big factor is the passive investing funds. Can you elaborate a bit more on that? What is that? And
Sure.
is it still in
Sure.
place?
What I'll do is give you the elevator pitch and where to find more. So the person that really did the original research and broke the story, so to speak, is a fellow named Mike Green. His handle on Twitter is @ProfPlum99. And he and anyone who wants to learn more about this, which everyone should, it's a ticking time bomb. But as Ira noted, you know, it matters when you do something about it. And I'm not saying you should today, but what you need to know is you need to know the game you think you're playing. If you've been around as long as Ira and I have, it's not the game that we grew up with. You know, investing in the 80s, 90s, and even the aughts was with their actual real markets. They were kind of distorted for various reasons, and of course, in the 80s and 90s, they were cheap. I dead cheap in 80 for sure. But the way we learned investing or trading is different now because the markets have been warped by QE. And more importantly, though, because of the regulatory capture, Vanguard and BlackRock get almost the lion's share of the defined contribution money, which is to say 401ks and whatever defined contribution plans are out there. They manage the bulk of the money. And when you send your money, if I was running your money, or some other professional was running your money, or Ira, if we were running your money like in the old days, I used to manage money, if I got a new account, I wouldn't buy every stock that I owned because some of them might be closer to selling or there might be the wrong price. I'd buy the ones that I liked and I'd slowly work it in and I'd try to manage the risk. Vanguard and BlackRock, it's a passive robot. I have cash. I'm buying everything I own in the weightings that I have. Generally, the big weightings you have are because they've gone up a bunch, and a lot of times that means they're more expensive. It doesn't always mean they're more expensive, but it generally does. And so all they do is keep voting for the same stocks over and over. And I think Warren Buffett was the brilliant mind that said in the short run, the market is a voting machine. In the long run, it's a weighing machine. But passive has tortured that to where it is way more a voting machine right now than a weighing machine. That's probably one of the reasons why he has $270 billion in cash. What you need to do is understand this. What this means is that what will upend this is, so if 40% to 50% of the daily trading, some number, it's not exactly knowable, is this forced money into the market, that's all fine when it's going up. But what happens when that forced money goes the other way? And what would cause that? Well, if employment diminished enough that they didn't have enough money relative to the current market cap to profit, or if the retirement money, the baby boomers that are taking their money out or reducing their equity exposure, if that balance tips. So either one of those two things could happen in the next year. I follow Mike to try to stay on top of that, and that's what people should do, because if that changes, then the kind of air pocket we saw last Monday when the yen blew up, we could see those kind of things routinely because you don't have this artificial bid structure. So that's the elevator pitch on why you need to know that, but you need to be aware that it's still there operational, and what we have to worry about is when that changes.
Mm-hmm. And your thoughts on that, Ira?
I just that's right, because knowing, I mean, but that's the critical element. As again, I talked about this last week. I did something with the Tasty Trade with Victor Jones, which was when we talked about this. You could see it. The yen, and as Bill will, and I know I haven't talked to him. We've never talked this.
Right.
If we go back to late April, Richard, as well as early May, we had 2 days of intervention from the BOJ. The yen had a thrust up, but then it spent the next 6 weeks making, 6 weeks making new lows. So those were one-off events. Come July, and Richard, you and I have talked about this on other podcasts too, the yen stopped making new lows. In fact, when it would rally, the breaks were to higher, I'm talking about in futures terms. I could talk in dollar yen terms, but I'll keep it in futures terms because Judd can show that chart. And you look in July, the breaks were all holding higher areas. So I said, something is going on here, right? Something is because we're not replicating what we saw before. So now somebody has gotten a message.
Mm-hmm.
Well, then, Bill, I have a son who's a political expert, well-respected expert on Japan. In fact, he wrote a book on Abe called The Iconoclast. But
oh, interesting. Okay.
Yeah. If you can, it's an unauthorized.
Okay.
Article. But not late, but about July 22nd, he puts out a piece, it has nothing to do with me, talking about how all of a sudden the 6 most probable leaders of the LDP are now all talking about the negative aspects of the weak yen. And I'll send it to you afterwards. I still have it. And they have all 6 of them and Kishida's at the top. Now all of a sudden there's a concern about the weak yen.
Just as parenthetic, I was surprised it took them so long to be concerned about that, because they had an inflation problem and the yen was going down and was making it worse. But of course, the Japanese listen to their own drummer, not anything that we think they should do.
Well, right. And I think too, and I kept wondering, and Louis Gavea talked about this. And Louis and I did a podcast probably almost 2 years ago when we saw certain things going on. And Louis raised a point that maybe as they were looking to reshore from China, the G7 had basically gave a nod and a wink to allow a weaker yen, to put the yen so the Japanese could reshore some of that industry back to Japan out of China. But that put and if Judd, I didn't even have to ask. So if you look at the yen yuan chart, it was very interesting throughout that period of time. The yen was even weakening that whole time against the yuan and doing it. So and now that's Lewis threw that out there. I thought it was an interesting theory, but again, only theory. And you saw the way the currencies moved. So there was a lot to that. But all of a sudden we get to see these changes, and I'm going to send it to Richard right now. But you get to see the changes that politically there's a concern about the weak yen, which nobody had ever been, because they just have not been concerned about it. So I said, this is kind of melding with what the movement we've been seeing in the yen. And then of course you had the blowout over, a 3-day period when you did a nice job, and we probably went down to 141, 142 in dollar yen was it last Monday. So we got to see this, but it told you, as we're talking about, things were changing and the price action was changing. But the complacency of exactly what you talk about, because it bleeds, right? Everything you talk about as to who's controlling the passive money, and you can't blame them. The MEX yen, Judd, you could throw that up too, over the last 4 years of COVID, that's been on a one-way, well, it's been even longer than that, because as we've been reshoring out of China into Mexico, so you borrow yen, you sell yen, you invest in Mexico. Hell, you made, if you just did it by interest rate differentials with no currency movement, you'd make 9.5% to 10% a year. And you and I know that if we can guarantee our investors 10% a year, we'd be doing pretty well. But of course, we'd be in jail if we offered to guarantee them that. That's basically what the carry trade was doing. And yet the peso itself was going higher and higher and higher and higher. So it was a perfect trade. But then when it gets, as you point out, it gets a little top heavy, and the complacency, that was the beauty of Hyman Minsky. I'm such a Minsky fan because we know, and we've lived through complacency, and nothing creates complacency like easy money.
Yeah.
Stop right there.
Meet the Cedar Owl, a new economics and finance publication with a focus on environmentalism. We combine the Austrian School of Economics and Market Environmentalism principles for investing in a sustainable future. Follow the link in the description to get to know the Cedar Owl better, understand our values, our mission, exactly where we're coming from, and the type of content that we release on a cyclical basis every Thursday. Join us in targeting outperforming portfolio returns while making a positive impact on society and the environment through technology. Subscribe now for weekly insights, investment articles, and exclusive content.
Go ahead, Bill. Did you want to comment on that? Yeah.
No, he summed it up perfectly. Nothing,
Great.
nothing.
What about your thoughts in general, Bill, on central bank policy trends and also rate cutting, between the big central banks? What do you see as trends in rate cutting trends as well?
Well, I'm afraid that I'm no fan of central banking. I think that they are the engines of misallocated capital and dangerous economic outcomes. The Fed created the bubble by their mistakes. Obviously, the public was part of it too, but it was aided and abetted by the Fed. And of course, when that one blew up, when the economy was, it was easy to see the economy was weak, was in the wake of the 9/11 attacks. And so that got blamed, the weak economy was blamed on that rather than on the burst bubble that had been created by Greenspan. So then the Fed was too easy in their policy afterwards. Both Greenspan and Bernanke actively cheered on real estate. Greenspan said specifically that real estate could never be a bubble because you can't arbitrage real estate. You can't arbitrage Portland, Maine with Portland, Oregon. He literally said that.
Yeah.
I wrote a book about Greenspan called Greenspan's Bubbles, The Age of Ignorance of the Federal Reserve. And as you might guess from the title, it was not particularly flattering. Having said that, they've gotten incrementally worse and more responsible. Bernanke was worse than Greenspan, Yellen was worse than Bernanke, and Powell is worse than Yellen was. Even though he did finally take rates to 5%, they were easy way too long. It was obvious they kept rates too low. They did QE too long. These guys have no real understanding of the consequences of their day-to-day work at the Fed. They get treated like they're the firemen when they are actually the arsonists. So I have no, I mean, literally, they've enabled all the can kicking. I mean, we have to remember the politicians are worthless. They're all grifters. And if you let them kick the can, they will. Well, when the Fed monetizes all this stuff, buys $8 trillion worth of the debt, and all that, then you get to kick the can. You don't solve problems. Then we're going to get to a place where all of a sudden baby boomers are retiring. Social Security's, the flows have flipped. We've got this massive budget deficit, and we'll be stuck dealing with that in a moment in time. When that starts to matter, other bad things will be happening. So, and I say that about the Fed, but they're all just as bad. I mean, there's no real sound central bank, except for probably in the East Bloc, where they've recently seen the vigors of socialism and communism, and they understand what these things lead to, and they've been buying gold for their own banks. So I mean, gold is a vote of no confidence on the centrally planned outcomes of the central bankers. So I hold them in very low regard. As a consequence, they forced me to own precious metals, which I've owned and built positions up for the last 25 years because of what they do. And you can see other central banks, even though they're in the central bank club, are buying gold as well, because they can see that, the problems that are aligned against colored paper maintaining its purchasing power are pretty high.
Yeah, I totally agree. Your thoughts, Ira, on this also?
I can't agree more. And I know, because I know I've read some of Bill's comments about Greenspan over the year. In fact, Bernard Connolly just came out with a new book. I haven't read it yet.
Oh, really?
Yeah. And this will be his last book, because he said, but Bill Shepard and I, a very good friend of mine, we brought Connolly's previous book, The Rotten Heart of Europe, back into printing, in which he wrote a new foreword for it in 2012. But he's written a new book. You can find it. And he's talking about in it, because I knew he's been working on it for years and thinking about it, basically because he always accused Greenspan. He's a capitalist, but he always, when it came to Greenspan, he always said, you always hurt the one you love. And I think that this book he takes off from that and finishes what his thoughts have been. So very interesting that you go that route. And I think, and again, yeah, and gold doesn't go up, as you rightly say. Gold doesn't go up because of inflation. It's a hedge against central bank credibility, right, to me, right? Because
same here, yeah.
Bernanke showed us that central banks, except for the Bank of Japan, could tolerate anything but deflation. They're not afraid of inflation. They're afraid of deflation, because, especially Bernanke, whose doctoral work was based on what happened in the 30s, and that the Fed and the Treasury erred so badly in 36, 37, and they were starting to get to escape velocity out of the Depression, but because of the mistakes they made. And you saw when Bernanke had a chance to enact that, QE1, as I argued, and I've talked about it before, that I argued with Santelli about live on air. You need QE1 because you couldn't go into a massive liquidation of assets. QE2, QE3, and beyond, for the life of me, I never understood that. And I think we have suffered the ravages of that. And anytime they want to pull back from it, again, Bernanke's famous temper tantrum in May of 2013, then that was a classic example, because as he started to do quantitative tightening, the markets revolted and they threw a tantrum, and he caved. Powell caved. They all caved because they're terrified of it. And when Bernanke came out with his book, The Courage to Act, I said, that's misnamed. It should be The Courage Not to Act. For the life of me, exactly. Misnamed. But I'm just, because everything that Bill says, and gold, yeah. If people say, oh, you're a gold bug. No, I'm not.
Yeah, exactly. Why don't they ever call them spoo bugs? Yeah. It's like only gold bugs. Well, you mean they're spoo? Like, come on, why the disparaging moniker? Just because, you know. Anyway, sorry, I didn't mean to interrupt.
No, you didn't. You didn't. It was a good place. Or here, I'm looking at treasuries. Why aren't you a treasury bug?
Yeah, exactly. I used to say that Greenspan ran the Fed on the applause meter.
Yeah.
Bill, you mentioned like over the last 25 years, you've been building up positions in the precious metals area. I was just wondering your thoughts on the potential rotation. Actually, 24 years ago, you were instrumental. I was listening to your commentary and analysis on the Mag 3 at the time, and I was heavily into Lucent Technologies, Cisco Systems, and Nortel Networks, and sort of provided serious consideration to analysis on the Mag 3 at that time as being very much overextended, overvalued. Do you think the Mag 7, there could be rotation to like value equities or hard assets, commodities?
No, not really. I don't think the rotation can really work because those things get bid up because of the passive. If it was a free market and there was a bunch of individuals at the margin running money, whereas active money managers are being redeemed and the money's going to passive. So if it was the market back when Ira and I were really active, yeah, that would have happened. You could never get to that place. It would eventually start to shift. So it's hard to, passive is not going to shift. It doesn't shift. What has to happen is, you know, gravity will come to the rescue of some of these stocks, or the upside down rescue downward, or passive may change, but I don't think you'll see the passive isn't going to rotate. What could happen is as more companies start to stumble operationally, the active people that are out there, whether they're individuals or hedge funds or institutional investors, may start to see that, hey, these some of the gold stocks are actually doing well because inflation isn't killing them like it has in past cycles for various reasons, and the underlying product, i.e. gold, has created a huge margin for them finally. So I think that there won't be a rotation from Mag 7. There could be a rotation more towards some value, but more likely, I think we're going to get a rotation into the precious metals and some of the miners themselves. If you look at the GLD as a reference for sentiment, in the middle of 2020, where the amount of ounces that were held by the GLD itself, it's down by a third now. Meanwhile, the price has gone from, say, 1,700 to 2,400 and change. So we've had this big move that in the aggregate, American retail or institutional investors, hedge funds, have not really participated in. If you look at the open interest, it's not distorted and bloated. So there's not a lot of hot money in there. And the miners suffer from the same thing because there's been no real recognition on the part of US investors that this is something they need. I believe that as the gold complex, metals complex, precious metals area does better, then the fact that it will be going up when other things aren't doing well, that's like free advertising, right? So I think it'll happen, but it'll happen like that. In terms of investing in the mining sector, I was the lead director at Pan American Silver for about 16 years. So I've seen the business up close and personal. And the problem is, mining is a difficult business. And there are a lot of smallish mining companies that have been, cobbled together. But the problem is, if you really want to sleep at night, you need to have your assets in a safe jurisdiction. There aren't that many of them anymore. You want to have mines where the ore body itself has a high grade it covers up a lot of mistakes rather than a low grade, which exacerbated mistakes. You want to have a properties where they can move the needle with their own drill bit, where they have exploration potential. And then you want to have management that you can have some confidence in, who's going to do the right thing for the shareholders, not for the necessarily the employees and the board first. So that's a small list of companies. And so, but what's happened this year is, for the first time, so I've been involved in the precious metals at a plus or minus amplitude for the last 25 years. And these mining stocks, I've upped my exposure or taken it down. But this year, for the first time, the higher quality ones that tick those boxes I just gave you have done better versus the other ones. So somebody's noticed the better positioned companies versus the others. There hasn't been a big move in the industry itself yet. You haven't seen some of the big dogs like Newmont and Barrick go up very much, mostly because they're pretty mediocre. You know, they need that's a bet on the price of gold, whereas these other ones are more of a function of, can the companies execute what's in front of them, and this price of gold doesn't have to go up for them to do well. But that's a small list of companies like that, but that's the way I think about investing in the sector.
Mm-hmm. Wow, that's great points and insight. Your thoughts, Ira?
Yeah, Bill covered this great. And, you know, I've learned this over the years, because when I started out in the business, one of the first people I met was Jim Sinclair, who was, you know, but for other reasons, I mean, and I know somebody through Jim, John Crowley, who preaches this, and John knows more about. Bill just laid it out, everything that John Crowley. I don't know if you know John Crowley, Bill. He was on Wall Street. He was with Jim, but he was with others, and he handled a lot of gold stocks.
Okay.
So I learned from him. Now, a couple months ago, we talked about, I actually started buying Newmont following Druckenmiller, because Druckenmiller put out, and I have great respect for Stan. When it comes to global macro, I don't know that there's, when it comes to executing global macro,
no.
he
and Paul Jones are in a league by themselves, right?
Yeah, a league by themselves. And I had a relationship. I'm such a bad businessman. I had Paul's money back in 1986 and 87. And all he did was try to grow me. And all I did was try to say, I can't trade any bigger. I can't. So I sent him his money back. He says, you're making a big mistake. Yeah, we'll get into that mistake at some point.
I actually ran a little money on the short side for Paul for a few years in the aughts. Anyway, he's a great guy. He's a great guy.
I'll go back to that. So talking about this, because people always ask me about gold stocks, and you just laid it out, because Crowley talks exactly. And, you know, I always go back to Mark Twain. You know, what's a gold mine? It's a hole in the ground with a lyre at the top.
Right.
And you have to be careful. And that's why people say, well, why aren't the gold stocks going up? Why aren't the golds? Well, they're companies. And if they're mismanaged companies, here we're sitting and talking, and I have it up right now. To think that Barrick, which has been probably the greatest disappointment of them all, and when Monk left, but then it was taken over from the management from the guy from Goldman, Barrick is actually up 8% today. This is probably the largest day, the biggest day it's had. So somebody's getting a little bit antsy here, but gold's had a nice rise.
But Ira, it's only the bigger ones and the better of the bigger ones, like full disclosure. So I own Agnico Eagle, Alamos Gold, a smaller one called West Dome. But if you look at those, how they've done this year, they've done even better. And I'm not trying to say I'm such a great stock picker. What I'm pointing out is that there's certain ones that have done way better, and they've done way better for really good reasons, which suggests to me that even though there's not a lot of interest in the sector, some people that are smart at the sorting process have figured out the names to be in, right?
Yeah, 100%. And you really did a great job of laying it out for people to be aware of that, because they're not all created equal, and everybody tries to. And again, let's go back to those passive concepts, because then they'll put them into an ETF, and you're buying all the crap.
Exactly.
Right. So
exactly.
I'm returning to your theme, which I think is exactly the right theme, is that why should I buy crappy companies? Do the work and find out which ones are actually
right,
have at least a higher probability of succeeding. You know, it's
Right.
the same in banks. You know, they put it together a
Yeah.
banking index. I don't want those crap banks. I'm looking around the world for the best banks. And if they're not going to make it, the other ones aren't going to make it either. So I may as well go best and put more money into the better ones than, you know, I don't want to be an insurance company. I want to be
Exactly.
an investor.
Exactly.
And further to that, Bill, do you provide consideration in the precious metal sector on streaming and royalty type of companies versus mining companies?
I don't, I own one well, royalty company that has some, there's a difference between royalties and streams. And I don't want to get buried in the minutia there. I feel more comfortable with royalties than streams for a couple of reasons having to do with production capabilities. But I always found them to be a little more expensive, and I don't necessarily think that they justify that premium. They're certainly less capital intensive, and you in some ways people are enamored of the optionality of what they have. But you know, they have to make sure that they back the right horses, right? If they back a project that doesn't turn out to be as economically sound, or it takes far longer, then you can have a problem. And then you also have the, like what happened to Franco-Nevada, right? They had this big copper project, and all of a sudden they're sideways with the Panamanians. So I own one that was spun out of Pan American, and I've owned it for about 5, you know, and now it's merged in with an entity. It's called Triple Flag. The Elliott, as in Elliott and Associates, have the biggest position. They put the company together, and it's merged with one that I owned. I've owned it for a very long time. So my problem with them generally is evaluation, and but that's not to say they aren't good investments. I just feel like I can get more torque for my dollar where I can manage it, and I don't need to have a pie in the sky view of gold prices to do well. So I'm not very big in them. I like the business, but when you go to try to invest your dollars and you look at what you're getting, it just didn't feel like enough rubber was meeting the road for me.
Mm-hmm. Yeah, that's fair enough. And any thoughts, Ira, on the
I think
streaming?
that's exactly right. And we return to the theme that Bill opened up with, which is the passive investing. Yeah, and do some work. You know, I get on people because they're willing to stream a TV show and watch for 12 straight hours. But if you say, go take an hour and actually dig a little bit, you might be surprised at what you find. And they go, oh, it's too, no, it's not. Go do the work. But I wanted to come back to one other aspect about gold, because interestingly, there was an article in the FT this morning by Toby Nangle. Swiss central bank will struggle to break its interventionist habit. Now, the Swiss have, you know, there's other levers to the carry trade in the world. The Swiss are definitely part of the carry trade because they grew their balance sheet. Forget the Fed, because we'll never know where that money went to and how it plays out. We can only guess at it. But the Swiss were very direct, like the Japanese. They grew their balance sheet from probably about $50 billion to $950 billion because in an effort to curtail the strength of the Swiss franc. But what did they do? They bought equities. They took basically $900 billion that they created in Swiss francs, sold them into the market, and then took them to a level and bought stocks. You know, the Swiss National Bank is the third largest owner of Apple shares in the world. Yep. I mean, when you think about that, well, that's part of the carry trade, and you see it unwind now. They go back and forth. But the article was Swiss central bank will struggle to break it. So, and I've thought that the Swiss should have done this, and they actually shrunk the balance sheet by about $3 billion because they were looking for room to play when they could. When the Swiss got weak enough, then they bought back the Swiss by selling out some of the equities. I don't know why the Swiss National Bank doesn't replenish its gold reserves in a big way, because they had sold some off because they were mandated by a referendum. But in the article, hints at it. It's actually a pretty good article and very timely. It's in today's FT. But I'm looking for the Swiss to become a pretty big buyer to add to the gold, because they're a bank that's been missing in this, but they've got real assets to convert. If you want to talk about, a rotation, it's time for them to rotate totally away from equity based and more liquid or fiat based into a little harder assets, because they're prone for that anyway. So that's something I'd be on the lookout for.
Any thoughts there, Bill, on central banks getting into gold, and in particular the Swiss National Bank?
I mean, obviously they're close to gold, given how much of it's refined in Switzerland. They know the story. I mean, I hope Ira's right about that. I mean, it makes sense that they would do that. I mean, obviously their cost of production on printing up Swissies is nothing. So even if they have a bad Apple investment, they're still going to get something if they sell it. I mean, to think that you could print up paper and buy gold with it, if you had a brain, you'd be doing it all day long. I mean, obviously the Chinese are doing it, even though they claim to have stopped. I have some pretty good sources that suggest that's really not the case. They just, why tell the world you're buying it when you're as big as you are? Tell them you're not buying it and see if you can get it cheaper, which I think is what they're up to. When the Swiss National Bank joins the party, then we'll know we're finally at least in the 6th or 7th inning of this game, right? For right now, it still seems like we're really in early days, even though gold is $24.50, a price a lot of people thought would never happen.
And just a final question, are there any other geopolitical risks that you see potentially affecting the financial markets and the economy, Bill?
Well, I mean, we've talked about a lot of the economic, and we have no leadership in the world, really. I mean, when the British are threatening Americans for what they might post online, and they want to come and get us for doing, I mean, it's and unfortunately, the U.S., the way we responded to Russia with the sanctions and threatening, to take your money, it casts a shadow over the dollar. Now, the dollar is still superior to the other colored paper, but I think confiscation risk and fear of authorities, I think at the margin is either going to make you want to own Bitcoin or gold. I'm not in Bitcoin for a variety of reasons, but I think the geopolitical and totalitarian-like risks are higher and growing, and I think at the margin that might be beneficial for the metals. When Ira still had a full head of hair and mine was black, people, it was common sound portfolio management that you would have 5 or 10% of your money in gold. That kind of ended in the 80s for obvious reasons, but no one's thinking about that. Well, if people started to believe that this is a bedrock piece of a portfolio, and the world started to allocate there, the prices would go much, much higher. None of that's in the price. People aren't even talking or thinking about it. So, any case, I mean, that's what I would say as the cherry on top.
Very, very interesting. Yeah. And your final thoughts, Ira, on that?
That's it. He opened up a Pandora's box. So not only did he have to tell me that he didn't suffer the slings and arrows of the yen, he had to go after the hair. I was leaving it alone, but
Okay. Okay.
But, and this is really a great, I loved, he threw in a word there that is absolutely right, totalitarian, because that's such a bugaboo of mine. And it's actually something I've studied quite in depth when I was a student and I had here in Madison, Wisconsin in graduate school. So, but it is, we live in that world. It is, and people really don't understand the importance of that word, because you're not comfortable doing anything of any type of liberty or freedom type of action. And we are seeing totalitarianism. And Canada, what Justin Trudeau did during COVID with the truckers, Richard, better than anybody sitting here.
Oh, yeah.
Totalitarian action. And you now have more people mimicking that, where, the fact, and I tell people, you don't want electronic money. Like electronic money, and it's not conspiratorial, but you have to understand what they want to do. They learned with electronic money that they control your money. And then people say, what do you mean? I said, well, if all your money is electronic, I can take interest rates, and the ECB and others said this. In fact, I think Larry Summers and Rogoff both did some research on it, that I can take interest rates to -5%. And I don't have to worry about you stuffing it in your mattress, because that was always the fear. If you went negative, you would get into a deflationary cycle, which would be terrible. Now they force you to spend it once you go electronic, because you really no longer control it. And again, you have to think through some of this stuff. So I love where Bill goes, because it doesn't mean you can't there's not great investment opportunities. I think Bill and I would agree on that. You have to find them, but there are pratfalls here, and the politics, and it's not domestic, because, I wrote a blog actively for 13, 14 years, never talked politics. And if you wanted to talk politics, you didn't belong at this blog, because I wouldn't engage with it, because it's not about politics. I don't want to, if you know my politics, I've done a bad job of getting across my ideas. My politics should have nothing to do with it. But totalitarianism, that's devoid of politics. You can get it from the left, right. It can come from all kinds of places, but it's something to be very wary of. And I think that Bill makes those are great points, because they want to grab more and more. And I have to throw this out today. Chris Whalen wrote a great piece that's in the public domain today about what the Fed has done, starting, again, as we began this, so we may as well end there, with Greenspan, but especially Bernanke and Yellen, and to Powell. Because I think Powell wants to do the right things, but he just, and I'm not talking about holding rates, because I would have argued you should have cut rates. Rich, I was adamant about that. I think it was a great mistake, because I'm a real yield person. Everything to me grabs value off of what real yield is, which is, of course, to me, overnight money versus the inflation rate. And I think he had room to do it and get out of the way. Now his hands are going to be tied, because it's going to be hard coming into the election. But that's besides the point. I think Bill's points are well taken. And I think, really, I wasn't sure what to expect. I think this has been a great podcast. Not that we've told you exactly what to buy, but how to think about when you invest. Right. And I think that's the most important part.
Right. I totally agree. Thank you. That was a great point.
And just closing up, Bill, how can our listeners and viewers learn more about your work?
Well, if anyone wants to follow me on Twitter, my handle is @FleckCap. And then my website is FleckensteinCapital.com. I write a column and answer questions. And it's I think it's $130 a year, so it's not expensive at all. I refuse to do it for free, and I've been doing it for a long time, and anyway, so it's a a kid with a paper route can afford it.
Yep. Great. And from your direction, Ira?
I'm going to say, I do these podcasts, but Bill is far smarter than me. Dennis Gartman warned me when I wrote the blog, don't give it away for free. Don't give it away, Dennis. He says, once you give it away for free, people expect it for free.
Yeah.
And so I applaud you. I think I was absolutely great. And you can find me here. I do some other podcasts. I really enjoy, I will get back to blogging, because I enjoy the interaction, not online, but in words. And I'm glad to make this, and hopefully Bill and I will have an opportunity through you, Richard, to do more, because I think this was really important. We covered a lot of ground. I think we can go other places that we didn't get to, but
yeah, it was really fun. Thanks.
Yeah, it was really fun. I appreciate it.
Fascinating discussion. Thank you so much, Bill and Ira.
All righty. Thank you.
Okay. Thanks.
See you guys.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.